Hi everyone, welcome to the video for Chapter 8. In this chapter, we're going to talk about detecting fraud red flags as well as the targeted risk assessment approach. I'm going to try and go through this relatively quickly. So anything that I don't cover in this video, make sure that you read up on in the textbook. So this video or this diagram is what they call the fraud risk universe. And if you think about risk assessment from your auditing class and thinking about inherent risks and control risks, this is basically all the areas that those risks can come from. So we can have certain risks that come from our board of directors. We can have management risk, supplier risk, employee risk, competitor risk, customer risk, and we have all the different types of risks that can come from all of those various places. So we've spent the past 3 weeks talking about these different types of fraud schemes. Here, we see many of those listed, and this diagram just shows us the different sources of fraud. Publicly traded corporations have to establish, implement, and maintain a formal fraud risk management program, and that's going to include being aware of the risks from all of these various sources. So management is ultimately responsible for our internal controls over financial reporting. But we know that internal controls are not always perfect. So what happens when a senior manager initially or intentionally overrides a control in order to commit fraud? Here we have various procedures on what we can do as auditors or fraud examiners in order to identify those breakdowns in internal controls due to overrides and collusion with management. So the first one is to examine journal entries and supporting documentation. So this is going to determine if journal entries have proper authorization, approval, documentation, and sign off according to the company policy. The next piece is to review significant accounting estimates. So those estimates are a really easy way to kind of manipulate your numbers. So looking for documentation of the underlying assumptions, comparing methodologies to the prior year to see if the assumptions have changed, is one way to see if we could have management utilizing those estimates to fudge the numbers the way that they want them to. Scrutinize unusual one-time adjustments. So this is just to ensure that they have all the proper authorization and that everything is above board. Because again, these are areas that could be easily manipulated. And then finally, an analytical review. So here we're just looking for anomalies that just seem out of the ordinary. So these are the various procedures that we can go with or utilize to try and identify if we have some overrides or collusion that are breaking down that internal control framework. So auditors do not have to plan or execute an audit with the intention of finding fraud. So if you remember back from our fraud classes, our goal is to provide reasonable assurance that financial statements are free from material misstatement, whether caused by errors or fraud. So if we happen to find fraud in the general course of our examination, that's great, but it's not the purpose of an audit. So these next few slides are going to talk about various roles in identifying fraud. So we know that auditors typically are not the ones that find fraud. And one of the reasons is we have specific materiality limits. So materiality is the amount that would change a user's decision on those financial statements. And we have to consider all of the users of those financial statements and determine the lowest amount that's going to change any user's decision. And that's what we're going to base our audit on. Well, our clients oftentimes will know what that materiality threshold is. And if they're smart, they're going to structure their fraudulent transactions below that materiality threshold. But that's the level that we are auditing to, is a material misstatement in those financial statements. So 8 steps that the auditor has to consider based on our generally accepted auditing standards in order to consider fraud. So the first is our brainstorming session. This is a meeting with the entire audit team to consider how and where financial fraud might occur. It's initially performed in the planning stage of the audit when we're just starting out and planning our audit, but these brainstorming sessions should be ongoing throughout the whole length of the audit. The second one is inquiry about fraud risk factors. So we should be inquiring with management, the audit committee, and others within the organization about fraud risk factors. And this is just part of obtaining that understanding of the client and the client environment that goes on in that planning stage of an audit. The third item here is to identify risks. So based on our understanding of the client, the auditor then is going to determine the type of fraud risks that exist and the significance of that risk in terms of materiality and the likelihood that that risk would occur, and then ultimately the pervasiveness of that risk. So how impactful is that risk to their financial statements? So that's the third piece here, is to identify those risks and kind of thinking about those risks as far as significance, likelihood, pervasiveness. And then finally, or not finally, number 4, we have assessing those identified risks. So we have to do that AR equals IR times CR times DR to assess the risk that we have. So we're going to assess those identified risks, inquiry of management, audit committee, and others about those fraud risk factors. And we're going to set our assessment of what we think that risk is going to be. After we've had that risk assessment, then we are going to respond to the results of those risk assessment. So the respond is altering that audit plan to address the risk. So we're going to alter the net of our testing. So for those of you that took auditing with me, net of testing means nature, extent, timing. So the nature, extent, and timing of our testing really details what tests we're going to do, when we're going to do them, how big does our sample size need to be, how many different tests do we need to do. All of that goes into the audit plan, and that's the response that auditors have relating to that assessed level of risk. Number 6 is to evaluate the audit evidence. So what we've talked about 1 through 5 really happens in the planning stage. And then you go about gathering all your evidence. And then in number 6, we have evaluate the audit evidence. So what this means is that throughout the audit, the auditors are going to reassess their fraud risks as they're moving along. They're going to evaluate their analytical procedures that they've done, and they may have to respond in some way, shape, or form to any of these identified misstatements that they have generated throughout their audit. Step 7 is to communicate fraud. So if we have identified a fraud through our audit procedures, we are going to want to communicate that. Typically, fraud should be communicated 1 level up from where it's found. So if we find a clerk who is committing a fraud, we would communicate that 1 level up, so to that clerk's manager. However, any fraud found in the senior management or management positions should be communicated with the audit committee. And then 8 is documentation. So remember, in auditing, if it's not documented, it's not done. So we have to document all of these various steps in our findings so that a reasonable reviewer could come through and know exactly what it is and how we reached our conclusions. So the audit committee. So what is the audit committee's job? So the board of directors has a primary responsibility to oversee management and direct the internal audit function as well as the external audits. The audit committee then is there to assure that the management has adequately assessed the risks of internal controls, overrides, and collusion among top-level managers and executives. So again, the board of directors and the audit committee are there to provide direction, set that tone at the top, oversee our top-level management, and make sure everything is going in the way that it's supposed to. We're going to talk about the internal auditors here in a minute, but we want to have the internal auditors reporting to the board of directors, or more specifically to the audit committee, so that they have that independence where they feel free to report if they find something that is a little bit off. If they're reporting directly to like the CEO or the CFO, well, that doesn't really alleviate that independence. And if the CFO is doing something wrong, you can't really report that he's doing something wrong to himself. So that's why we really would like to go to the audit committee, because these people should not have responsibilities over our typical segregation of duties. So the reporting, the record keeping, the custody, they're really there more of an approval and an authorization and oversight level. So that's how they can be effective in this process. So our internal auditors, so if properly organized, structured, and supervised, the internal audit group could detect and deter fraud. The primary deterrent effect is related to the increased perception that fraud perpetrators will be detected. So remember, when we were talking about some of the best ways to prevent fraud, it's to increase the perception that you are going to get caught. Whether or not you're going to get caught is kind of irrelevant, but how do people feel about the perception of getting caught? And by having effective internal auditors that are looking over everybody's shoulders, reviewing work that's done at various levels, making sure that the internal controls are functioning and not overridden, there's that increased level of perception that if I did something wrong, these internal auditors would find it. So their role in this fraud, not only are they overlooking and seeing things, but also they're serving as that perception of increased detection. So that's the big thing for those internal auditors. And then secondly, again, like I said, when we were talking about the board of directors, we want them to be independent, and we want them to be reporting to that audit committee in order to allow them for that independence. Fraud detection. So the internal control environment has either been ineffective or circumvented to allow a fraud to be perpetrated. So effective fraud detection is an attempt to identify the fraud as early as possible, in contrast to the optimal situation in which the fraud is prevented or deterred. So fraud detection, after the fraud has happened, how are we going to detect it? Here we're going to talk about a number of red flags and things that we can identify in order to find that fraud. And we're going to talk about some steps that we can go about in order, again, to detect the fraud. So ultimately, again, we want to prevent or deter fraud from ever happening, but once it has happened, how do we go about detecting it? So that's kind of what we're talking about here. So here we have a number of fraud detection areas, how we can detect fraud. So tips and complaints. So having that anonymous hotline where people who see something can come in and basically let you know what's going on without feeling like they're going to get in trouble is one of the biggest ways. Social media. If you see someone who's living beyond their means and they're, jetting off to Italy on their yacht, or they're buying, a $100,000 car and they make $30,000 a year, and they're bragging about these things on social media, that is a good fraud detection sign, because we can see people's extravagant lifestyles through what they're posting on social media. Behavioral red flags, these are things about how a person is acting. So are they acting irritable? Are they drinking more than usual? Are there other things that are happening, the way these people are acting, that seem out of the normal or what you would typically expect? Analytical anomalies, these are transactions or financial statement relationships that just don't make sense. For example, if we have some sort of like break in a pattern, so we would expect to see expenses at a certain level, and it's always at a pretty same level, and then we have a huge spike. Or we have unusual timing of transactions. So if we are closed on Saturdays and Sundays, but we're seeing transactions happening on Saturdays and Sundays. We talked about in the last chapter, if there were negative cash flow from operations, but they have a large profit. So how are they generating a profit but not generating cash flow from operations? So those are some of those analytical anomalies that we would like to consider. Accounting anomalies, these are unusual activities that seem to violate our normal expectations of the accounting system. So this would be things like missing documents. So typically we would like to see a nice little audit trail that has all of the documentation of various transactions. So if some of those documents are missing, that would be an accounting anomaly. If we have an excessive amount of voids, we talked about how voids can be used to steal money from the register. So if we are seeing a large amount of those, that would be an accounting anomaly. Increase in our past due of accounts receivable or accounts receivable write-offs. That would lead us to question whether those receivables were ever, the receivables and the corresponding sales were ever legitimate in the first place. So these are some ideas of accounting anomalies. As we are assessing their internal controls, thinking about irregularities or weaknesses within those internal controls, and then is there any non-financial information that could also help us with that detection of fraud? So these are various areas that we can use to help with the detection of fraud. And again, the biggest one is going to be that tips and complaints and the fraud hotline. So the use of red flags to detect fraud. So some of the questions that need to be answered in an investigation include, does the anomaly have supported documentation? Does the documentation appear to be falsified or altered? Does the transaction and its reflection in the financial statements make sense? These are some of the questions that we're going to be asking ourselves. So with each of the schemes that we have covered, we've talked about various red flags. But just because we see a red flag doesn't necessarily mean that there is going to be fraud. It could just be because, you know, the dynamic nature in which the organization operates. So we have to ask ourselves, like I said, a number of questions to help put those red flags into context. So a red flag is that anomaly. So what's going on with that anomaly? Is it supported? Is the documentation legitimate? Does it make sense? Using that idea of professional skepticism just to kind of answer these questions and put those red flags into context. The last thing that I want to talk about in this video is our targeted fraud risk assessment. So when we're in auditing, we talk about the risk assessment process. We talk about AR equals IR times CR times DR. And this is very similar. Here, it starts with the foundation of our knowledge, skills, and abilities in the area of fraud detection. So just knowing what we understand and what we don't understand, understanding the various schemes that can be used. So the fraud examiner has to know which accounts are the most susceptible to manipulation, what type of manipulation that can happen, the magnitude and likelihood of a particular scheme. So these are the things that we have to consider. So we have two different approaches. The first is the top-down approach. So in the top-down approach, we want to consider high-level factors such as the industry or competition, historical performance, management philosophy, possible pressure concerns, as well as maybe some geographical considerations, and think about it that high level of fraud. Then we want to determine the fraud risk. So determining the fraud risk could be which accounts would likely be utilized, such as revenues or expenses or liabilities or assets, in order to commit the fraud. And then finally, which scheme could be used to perpetrate a fraud and who might likely be involved in that scheme. So again, we're starting at the top, thinking very broadly about risk factors. And then we're moving down and thinking about what accounts there might be and what accounts could possibly be utilized to commit fraud. And then finally, which schemes might they use relating to this information and who might be involved. So that's that top-down approach. So your textbook gives you a 10-step targeted fraud risk assessment. So I'm going to go through the first 5 steps here, and then the next 5 steps on the next slide. So step 1 is to evaluate the economic, operating, and competitive environment, as well as the overall control environment. Step 2 is to include the identification of key business processes, as well as the difference in the processes identified between local and foreign operations. Then in step 3, we want to identify the process owner. So the process owner is the individual who has the day-to-day authority and ability to alter the standard operating procedures. So who can do management override to accomplish the goals and objectives of that organization. So step 3 is to identify that process owner. And then in step 4, we want to review our past fraud experience with this company. So that could be considering not only what type of fraud have occurred in the past, but also where geographically or in which accounts did the fraud occur, where within the organizational structure did fraud occur, who committed the fraud, how was the fraud perpetrated, how could that fraud have been prevented, how could it have been detected, what have we done since this has been identified. So just kind of, again, step 4 is reviewing that past fraud experience. Then in step 5, we go into identifying how fraud may occur in each process and at each location using fraud brainstorming techniques. So this is going to ask what could go wrong, using brainstorming techniques with our process owners and with the sub-process owners, sitting down with each of those people to identify how fraud may occur in the respective processes at their various locations. So that's the first 5 steps. Now our last 5 steps, steps 6 through 10, in step 6, we have identify the parties who have the ability to commit the potential fraud. So identifying parties who have the ability to commit that fraud and might need to be further examined or looked at more closely. Also, we would want to consider the elements of the fraud triangle. So here we're thinking about who has the ability. That would be more of the opportunity part of that fraud triangle, but also thinking about the motive and the rationalization piece. So thinking about all 3 of those steps. Then step 7, evaluate the likelihood that each of the identified frauds could occur and be significant, as well as the persuasiveness of the potential fraud. I think that's supposed to be pervasive, not persuasive, without consideration of controls. So during step 7, we're going to assess the likelihood that each of the identified frauds could occur on the scale of remote or reasonably possible or probable. So we're going to kind of think about, okay, here's this risk. What's the likelihood that it could happen on this kind of 3-point scale, as well as the significance. So management should address those fraud risks that have more than a remote likelihood of having more than an inconsequential effect. So again, we're looking at the likelihood as well as the magnitude, and we're trying to address things that are reasonably possible or probable that they're going to happen and are more than inconsequential. So inconsequential, if we think is like in terms of materiality, would be those immaterial things. So something that's a little bit more than trivial are things that we would like to consider. Step 8, consider the likely methodology to commit and conceal the fraud to determine the level of mitigation to prevent, detect, and deter the fraud, and the result is a determination of the existence of residual fraud risk. So in step 8, after we know the risk, we have to determine what factors the organization has in place to prevent, detect, and deter each of those risk factors. This is going to fall in line with the COSO framework and the 5 elements of internal control. So what have they done? So here's the risk. What have they done to prevent, detect, or deter this risk? Then we're going to weigh the risk versus these various factors that they've put in place to see how much is left over. So I'm going to give you an example Just to kind of put it into numbers. So let's say there's a 50% chance that a certain fraud risk might occur, but the organization has put in tons of controls that would prevent, detect, or deter 90% of this risk. That means the remaining or the residual fraud risk would be 5%. So 50% times 10%, the 10% that's left over after those preventative controls is going to be 5%. So that's this idea of residual fraud risk. So we're going to identify the risk, what's been put in place, and then how much risk is left over after we've considered those controls. In step 9, we're going to investigate the characteristics of potential fraud manifestation within each process identified in each residual fraud risk. All right, so here, this requires the fraud examiner to investigate the characteristics of potential fraud manifestation within each process. And we want to know if that residual fraud risk exists. So have they completely put controls in place to prevent, detect, or deter 100% of that fraud risk, or is there still some residual risk remaining? So when in step number 9, we want to think about designing procedures to look for fraud. So how can we investigate these things? Thinking about data mining. So how can we mine our data to help find these anomalies? And then finally, what procedures are we going to do to look for that fraud? And then step 10, the last step, remediate fraud risk schemes by designing control activities to mitigate the unmitigated fraud scheme risk. So after we have found that residual fraud risk, that leftover piece, in step 10, the fraud examiner is going to reassess and quantify our fraud risk given the steps from steps 1 through 9. And the fraud examiner is going to evaluate the results of the investigation, extrapolate that information over the entire population. And because the frauds that have been detected may just be the tip of the iceberg, we want to think about how much deeper that fraud could really go. So that concludes my discussion on chapter 8. This again is going to be a 2-chapter week. So tune in for my next video on chapter 9 and have a great afternoon.